Welcome back. You're watching Power Breakfast on CNBC TV 18. Well, let's shift focus to the IT stocks now because TCS and Infosys will be on focus. First up on TCS because that one reported a mixed quarter. The dollar revenue was in line while the margin missed estimates. Rima is here to tell us the key highlights. Rima, while there were no fireworks in the numbers, it wasn't a howler as well.
Well, the margin miss takes the sheen off the company's otherwise solid growth performance. So the big miss this time is coming on the margin front. The company has reported margins of 25.6%, much lower than estimates of 27.6%. It's declined by 90 basis points on a quarter-on-quarter basis. The two key reasons for that. One has been the cross-currency headwinds on account of the fact that the dollar's depreciated against the other currencies. And secondly, on account of the higher cost of doing business. So on account of the talent crunch in the US, for instance, the subcontracting costs went up by nearly 35% on a year-on-year basis, and this seems to be an industry-wide problem now, that the on-site cost structure seems to be rising, and that will put pressure on the company's margins even in the coming year. That said, on the growth front, it's delivered well. So constant currency growth of 1.8% on a quarter-on-quarter basis within, in line with estimates. On a year-on-year basis, it's 12.1%, the highest that we've seen in the last 14 quarters. The digital growth continues to remain strong. It's accelerated by 52% on a year-on-year basis. It now contributes over 30% to their revenues. BFSI also continues to accelerate on a year-on-year basis. BFSI has grown by 8.6%. The order book has gone up 20% on a quarter-on-quarter basis. So the total contract value of deal wins stands at $5.9 billion in the quarter gone by. And there has been, an increase in the $100 million client addition as well. So on most parameters, especially on growth, even in terms of the management commentary, they fairly sound upbeat. They're on track to end the year with a double-digit growth. But it's the margin miss which is a bit of a worry, and that's caused analysts to scale down their margin and EPS estimates for the year and perhaps even for next year.
From where we are, we see strong deal momentum. As I said, the order closure this quarter has been steadily increasing. It's grown almost 20% compared to last quarter. And on the pipeline front also, we are seeing steady build-up of it. Our deal pipeline adjusted for the one-off platform deals that we had, we are much better than where we were last year.
How long would you expect the UK minor tremors in BFSI to continue?
Difficult to say. We'll have to wait and see. That market is right now a fairly complex market. So we are participating well, but difficult to say as to what the impact of that will be given the short-term uncertainties in that market.
Okay, on that note, Rima, just stay on and tell us what the street is expecting from Infosys as well, because that big one number is also expected today.
Yes, after TCS, it's time for Infosys post-market hour. So we're working with a dollar revenue growth of 1%, constant currency revenue growth of 1.5%. Remember, the December quarter is not only seasonally weak, but it's historically been extremely weak for Infosys. So if you take a look at the December quarter of last year, it was a 0.8% growth. In the year before that, it was a minus 0.3% growth. So compared to what they've done historically in December quarter, this quarter's numbers will fare better on account of the fact that the company has seen some very strong deal wins. Margins will be under pressure. We saw that in the case of TCS as well, on account of the investments the companies have to make, as well as cross-currency headwinds. The key to track will be their FY19 guidance. Currently, it stands at 6 to 8% on a constant currency basis for the top line. Analysts like CIMB, Ambit, Kotak, they all see the lower end of the guidance being raised, which means the guidance could stand at 7 to 8% versus 6 to 8%, though there are Axis Capitals and the CLSAs of the world who believe the guidance will be maintained. EBIT margin guidance is likely to be maintained at 22 to 24%. That's because the company is already guided for higher investments in the second half of the year. The street will also closely track the buyback as well as special dividend announcement that is also scheduled in the board meeting agenda. The expectation is of a $1.6 billion payout. Other factors to track: deal wins, because it's been very strong, record deal wins in the prior quarter at $2 billion, high attrition at close to 22%, and the margins in light of the rupee appreciation and the higher cost of doing business, as TCS alluded to.